Wilson Magee, over the past year, the IYR, which is the exchange-traded fund which follows the REIT industry, has outperformed the S&P by a wide margin. Is it all about that yearning, that quest for yield?
Greg, I think that's part of the story, but not the whole story. The first part of the story is that in January of 2014, REITs were about a standard deviation cheap on a fair value to NAV measure, and so REITs were coming into the year cheap. They had very good earnings growth, so that really drove stocks significantly upward, but there's also a yield component to the story, and more investors are looking to equity vehicles that have more dividend yield, so that is certainly part of the story as well.
Digging down, what are your favorite REITs right now? Multifamily homes, labs, parking lots? What do you like?
On a fundamental basis, the sectors with the highest same-store NOI growth, which is property level growth for their portfolios, are the apartments, rental apartments of course, and storage REITs as well. But across the board, U.S. REITs are showing well above trend same-store NOI growth. For the fourth quarter, it was about 4.5%. Over a 10-year period, it has typically run about 3.2% a year. So the underlying fundamental income from properties across all REIT sectors is quite strong right now.
The biggest fear, of course, is that the Federal Reserve will raise rates and that will crush REITs. We even saw that with, I think it was a head fake a few years ago when Ben Bernanke even hinted at it. So talk about what happens.
Yes, the head fake you mentioned, Ben Bernanke talked in May of 2013, and that was really the interim peak in the REIT market. REITs reacted negatively after those comments, and that's what caused them to get very cheap because their fundamentals were so strong going into 2014. We've done a good bit of work as well as others in the industry, and for the most part, over the last 20 plus years, when you've seen over a 100 basis point rise in 10-year treasury yields, there have been 9 episodes. REITs have actually had positive performance in 6 of those 9 periods. And on average during those 9 periods have actually had an average compound annual return of about 11.5%, which is very positive. Subsequent to those rate rising periods, REITs have performed extremely strongly at over 20% a year on average. So we'd really recommend that investors be wary about rate increases for REITs, but also be prepared to take advantage in this kind of fundamental environment where their earnings and same-store NOI growth is so strong.
All right, so fear not the Fed. But what about global REITs? Because right now you're seeing more and more investors look abroad, not just for stocks, especially with the declining euro and declining yen, but they want to buy property abroad as well.
Mm-hmm. We certainly believe global REITs represent a good opportunity for investors who would like to be global in their portfolio and want to allocate to real estate. And much like U.S. REITs, they are trading right now at about fair value to their underlying net asset values. And so we think they have appeal to investors who really want that global exposure as well.
And then finally, is there a type of REIT people should avoid, or maybe if the yield is too high, they should stay away because it's not sustainable?
Yes, we would always warn investors to be wary about extremely high yielding securities, including and particularly in the real estate markets. We think it's typically a sign that those dividends may be potentially cut. Fortunately, in the U.S. REIT market, that really isn't happening very much today. And in fact, over a 20-year period, U.S. REITs have had average annual dividend growth of between 7% and 8% per year, and only 1 year in which they cut dividends, and that was in the financial crisis. The first part of your question, the most sensitive U.S. REIT sectors to rate rises are healthcare and triple net sectors because they are reliant on spread investing for their growth.
All right, thanks a lot, Wilson.
Thank you very much, Greg. Pleasure to be here.
Thank you for watching The Street.